Okay, perfect. So we're back. Let's start with alpha and beta, and how do we outperform the benchmarks. So this time I'm trying to make it more, I would say, interactive. So why doesn't somebody unmute themselves and tell me what alpha and beta are based on their understanding? Anybody who wants to go? Anybody who wants to talk about what is alpha and beta?
So alpha would be relative outperformance with respect to the benchmark that we are trying to outperform on a per stock basis or probably on a per sector basis.
Perfect. So alpha is really about what is the outperformance that one can generate over and above the market benchmark. Okay. What is beta then? Anybody else?
It is unsystematic risk.
Unsystematic risk. Elaborate on that a little bit.
Uh, there are two types of risk: systematic risk and unsystematic risk.
Mm-hmm.
So generally, beta greater than one uh, is of that particular asset is of high risk, and beta below one, uh, the risk against the asset is not that much.
Hmm. Fair. I would not define beta in terms of risk, but more in terms of the return. Uh, let's go ahead and see what it is.
Proportionality may be more to do with that.
Correct. Yeah. So yeah, you can define it as a risk, but uh, if you look at it this way, that you have a portfolio. Every time Nifty moves up by 1%, Reliance moves up by probably 0.75%. Okay. So
Hmm.
what is the movement of a particular stock or a portfolio of stocks compared to the index? That is something that gives you the beta of your portfolio or beta of that particular stock, right? So what happens is that you have a particular stock. If Nifty moves down 1%, that stock will move down 0.75%. So in that case, the beta would be 0.75. Okay, because the movement of the stock is really related to the index. So every time the index would move up or down, the particular stock will follow that. Okay, but alpha really is sorry about that. Alpha is actually the excess return, okay, which you earn over and above the market index. Okay, so if some of you who had a small cap portfolio, and all of 2024 you look at the small cap portfolio, and you got a 60% return, and you measure it against Nifty, which probably gave you a 15-17% return, you're very happy because it generated alpha. Probably not, because the correct benchmark that you have to measure yourself against was the Nifty small cap index, and that small cap index actually went up 60%. So probably you did not generate a lot of alpha. What you really generated was beta, and beta is nothing but how much would your portfolio move if your index is moving by a certain percentage. So your stocks really moved along with the index, which was a small cap index that you should be looking at, and that moved 60%. Obviously, most of them are down by about another 40-50% right now. But if you were to try and understand the concept of alpha, really alpha is the excess return that you can make over and above whatever that performance benchmark is. Now, you'd see a lot of mutual funds sometimes telling you that they have generated alpha. A lot of even fund managers telling you that they have generated alpha, and half the times you'll realize that they have not benchmarked themselves against the correct index. So somebody who benchmarks themselves against Nifty 50 is actually investing in Nifty 500 and telling you that they have achieved some level of alpha, which is not entirely correct. A lot of it is just the fact that they're not measuring themselves against the correct index. And if they measure against, Nifty 500, then probably their returns would be very different from what Nifty is performing at. Okay. Beta, on the other hand, yes, you can use it as a measure of risk also, but typically what happens is that for beta, if I try and plot it on a line, what happens is that if this is zero over here, and a particular stock has given you a return
We
which is
can't
like
see
this.
your screen, sir.
Oh, I'm so sorry. I'm so sorry. So you wouldn't have seen what I did even earlier. So okay, that's fine. I don't think we missed much. Yeah, I just talked about what alpha and beta are. Okay, so beta is basically something that tells you in terms of your portfolio or stocks uh, what is it that they're doing. If I were to try and plot this, okay, so this is the zero line over here, okay, and a particular stock has given you a return like this, okay, or if I look at, this is where Nifty is, okay, and this is where the stock is, okay. If Nifty was at this point, this is where the stock was, and I plot a line over here. If Nifty is over here, I plot different values of Nifty and the stock, and then see that this is how that stock is moving compared to the Nifty. So the slope of this line, okay, the angle that it forms, okay, is the beta of that stock. Typically, if you look at it just in mathematical terms, the slope that it forms is the beta of that particular stock. I don't want to confuse you. I just want you to understand. If you don't understand it, let it be. This is not relevant. Okay, this is something that was covered in one of the earlier courses, as in the level 2 course earlier. So I'm just trying to help you understand how beta is calculated, and this distance, okay, is called the alpha, because this is the excess return that you'll get. The return that you're getting over here, every time Nifty is at 20,000, 22,000, your stock will keep going up. So that is the beta, which is the slope of the line. But if Nifty is at a particular point, or even at zero, then the excess return that your stock will generate is the alpha that is there for that particular stock. Okay, just in terms of the representation. But let's look at how we calculate the alpha and beta. So this is one of the charts that's there in the book, and what they've done is that they've taken an equal weighted portfolio of five different stocks. Okay, and what are those five stocks? Mostly the tech names. Some of them from the Mag 7: Apple, Microsoft, Meta, Nvidia, Broadcom, and they've compared it against the S&P 500 index. So if you actually look at it, the line is the portfolio of five stocks, and this is how the S&P 500 has moved. Okay, so if you actually look at it, everything started from a position of zero, and then as the S&P 500 moved up, these stocks also moved up. As it came down, these stocks also came down. But if you look at it, in terms of how much, in terms of percentage, over here, it moved up by about 30%. I think the candles would be those five stocks rather than, uh, yeah, the portfolio is those five stocks. So the candlesticks are actually the stocks and not S&P. So these stocks and this particular portfolio has given you a return that is much higher than S&P. S&P has only given you about 15% return. These stocks have given you a 35% return. And that's what they're trying to show, that when we look at the scores of each of the stocks, this particular portfolio probably has a beta close to 2. Why? S&P moved up 15%, and these stocks have given you a 30% return. Even if you look at over here, S&P was probably around the 20% mark at this top. These stocks were around the 35% mark. Okay, so probably somewhere around 1.75 to 1. Or even around 2 is what is the alpha and beta. What I was showing you earlier is this particular formula, which is the alpha beta. If you remember uh, a straight line, okay, and some of you who had to calculate the slope, if you're studying maths, uh, that was y is equal to plus bx, okay, where b is the slope of this line and alpha is where it intersects the y axis, okay. So this distance is the alpha, okay, and this is the slope of that line. And as this particular number x is actually where Nifty is. So if Nifty is at 20K, 22K, this number will change to 20 and 22. This number will be what is the slope, how much that particular stock will go up if Nifty is at different levels. So if I were to look at this particular portfolio, what will happen is that if Nifty has gone from 20,000 to 22,000, which is a 2,000 point move, okay, or a 10% move, this portfolio will go up by 20%. Okay, that's what this formula is all about. And then they also have a thing about the risk-free rate, which typically comes in when you're building that formula. This is the complete formula in terms of somebody who wants to understand how alpha and beta are calculated. Not relevant for the exam, I'm just calling that out, but it is there in the book. And if somebody wants to go deeper into studying how the calculations work, you can feel free to go deeper into that. But again, your exam would be multiple choice questions. You need to understand how that formula works, but not necessarily actually have that formula something that you need to memorize. But having said that, if you actually look at the previous graph, we saw that this was at, just give me 2 minutes, folks, I'll be back with you. Okay, sorry about that. Yeah. So coming back to alpha and betas, alpha is the excess return. If you look at what's happening on the portfolio gave you a 34% return versus the benchmark that was at 17%. The risk-free rate that they've taken is 4.6, which is at the beginning of the chart. So somewhere at this particular point of time, that's the benchmark that they're using to figure out what is the alpha that this particular portfolio is able to generate. If you see, if some of you have been tracking the market, I don't know whether they've mentioned the year or not, but this is the time, even if it was 2023 or 2024, uh, this was the time where all these tech stocks really outperformed. So just looking at uh, the fact that these are the stocks in the portfolio, I was able to make out that probably this is not S&P. S&P is this particular line over here, where these tech stocks should have outperformed the S&P during that time frame. Um, Using that those numbers in the beta formula that we've seen over here, again, I'm not going into the details of it because that is not what you require in the exam, but just to help you understand, you'd be able to figure out that beta is 1.24, okay, which is the number that goes over here in the formula. So the beta is 1.24, which is basically how much the uh, portfolio moves versus the market. And if you put all those numbers into the alpha formula, what you'll be able to get is the actual alpha. And that alpha that this portfolio has generated is about 14.02. And if you actually look at the chart, the S&P, which is the index, only rose about 16%. Your portfolio went to about 35, so that's about 19%. And then you make some adjustments for the rate of interest, which was at around 4.6. All that together comes to about 14.2, which is the alpha for that particular portfolio. Let me stop over here, see if there are questions before I move on to the next example that's been taken over here. Okay, so that, if you look at it and figure out, these are all tech stocks, okay, and that's been compared with the index. And this was a period where the tech stocks really did very well, and hence they kind of outperformed. But if you used a different portfolio, which was of utility stocks, okay, so power stock, energy stock, certain company, I don't know what they do, but another utility stock, American Electric Power, Next Era Energy, all of those stocks from the older generation, things that worked in the past. But right now, most of what is driving the index is really tech. So we're doing the same thing. We're taking an equal weighted portfolio of these five utility stocks compared to the stocks that we had earlier, which are mostly tech stocks. If you look at it for a period of time, even when the S&P was moving up, okay, uh, these stocks were underperforming the S&P. Okay, at the end they did outperform a little bit. Okay, S&P went up 17.5%. These stocks went up probably about 22-23%. Okay, so the higher return for the one might naturally expect that the alpha score would be different between what we saw earlier, which was the tech stocks, the higher return of the growth stocks, okay, which is at 34%, and 34% is nothing but this number over here, versus 24.5%, which is the number over here. Okay, so 24.5% is how much the utility companies moved up versus what the tech companies moved up. Okay, your first thought would be that, hey, there's more alpha that you can generate using the tech stocks versus the utility stocks, but that might not always be the case. Okay, just looking at it in terms of what the final return is might not always be the case. So let's look at the formula. So the final return is 24.5, S&P is at 17%, risk-free rate of return 4.6, which typically is the 2-year treasury bill, is what is used over here. And then the beta comes out to be 0.53. If you look at it and just look at these two, sorry, there were a few questions that I missed. One second. Alpha and relative outperformance, the same. Uh, not Yeah, so alpha would be outperformance. Relative, uh, it's not relative outperformance, but it's outperformance. Okay, so I'm not sure about relative outperformance as a term. uh, Typically anything that is relative to the index is captured under beta. uh, yes, Vipul, I think a very good point. As the For high beta stocks, what will happen is that they will go down much faster than the market. Okay, so if the market is moving down 10%, you would have seen a lot of the small cap stocks have gone down 50%. 50%. Similarly, when the markets were going up, what was happening was that Nifty went up, 15%, and all the small caps went up 60%. Okay, so the typical scenario is that in a rising market, you can go with high beta stocks. But if you want to take a defensive position in a falling market, you'd want to lower your beta so that the stocks that you have in your portfolio go down less than what the market goes down. So, very good question. I think that's something that all of you need to keep in mind. So, especially for your longer term portfolios, if you are in a rising market, be my guest and run with high beta stock because they will always outperform the market. But if the markets are going down, the reverse is also true, and you're actually seeing that even in the Indian context right now, as the markets are going down, some of these high beta names are actually leading the downfall, and you know. If you look at the index is probably falling 10-12%. But a lot of the portfolios that people have, which probably had a larger component of mid cap and small cap stocks, they have been butchered really badly because, especially if somebody entered in 2024, most of those portfolios are sitting on losses. So much so that even the SIPs that people started in 2023 and 24 are actually right now negative in terms of, especially on the mid cap and the small cap stocks. Okay, so here's what we'll do. Let's complete this particular slide and then we'll stop. I know it's a little early, but let's stop over here. I'll let you guys go through the concept of alpha and beta. And then tomorrow morning at 10 o'clock, we will come back and start from this particular slide on where to find alpha. Okay, so the utility stocks, they did show much lower beta scores. Okay, because if you look at it, they do not always go in line with the market. So the market might be going up, the low beta stocks might still be going down. Okay, they don't necessarily follow the market and they don't track the market exactly the way the markets are. If you look at what's happening over here, you can see that as the markets were going up, the high beta stocks were going up, but as the market fell, okay, what you're seeing is that it just reached this level. But if you look at it, it fell from 35% to probably 5%. So there's a 30% fall when the market actually only fell around 17%. Okay, so that is the problem that you see in terms of a high beta stock, that they will fall much more if you are catching them in a falling market, and that's something that you'd want to avoid in terms of how is it that you want to build your own portfolios. So having said that, if you actually look at this particular one, where we're trying to see the average score of 0.5453 is well below the beta of the growth stocks. Okay, so even though the beta is lower, if you actually look at it, they have an alpha score of 13.13. Okay, so let's go back. What was the alpha score over here? 14.02. Okay, but over here, the alpha score for some of those utility companies that actually have a much lower beta is still very close to what the alpha is for these stocks. And the reason being that when you look at it, the beta component, okay, is very high over here. Uh, every time the Sensex moves 1%, these stocks move 1.24. But over here, as soon as sorry, the S&P moves up 1%, these stocks only move 0.53%, and that is where the alpha is being generated. So typically, if you look at a trading strategy in a falling market, you'd want to be in low beta stocks because once the market starts rising, they will tend to outperform initially. But once you are in a rising market, you'd want to be in a high beta stock where the rate of increase will be much higher than what a low beta stock can give you. Uh, and there are a few quick things that I just want everybody to be aware of, and and just reiterate. So one of the things that we did discuss about alpha and beta is the fact that in a rising market, you will have stocks with a higher beta go up along with the market, which you can see in this particular chart. And at the same time, if you are in a declining market, stocks with higher beta would fall more than what the market fall is. So if you look at the S&P over here, the S&P fell from about 18, maybe 19% to about 5%, which is about 13, 14%. But this portfolio stocks, which were high beta stocks, really fell from 35% all the way to 5%, which was a 30% drop. And secondly, if you have low beta stocks, they fall less than the market, especially in a declining environment. And that's the reason that if you're looking at a rising market, you're better off with high beta stocks. And you can see that even in the Indian context, in the small caps and even the mid caps, actually. And then if you are in a market that is going down, you'd want to get some protection and also ensure that your portfolio does not fall as much as the markets fall. And typically, once the market starts rising, the low beta stocks start rising before or in line with the market, but much faster than some of the high beta stocks. The other thing that you should also be aware is just when we calculated the alpha, okay, of the high beta stocks and the low beta stocks, the difference was very little. Okay, and that goes on to say that a lot of the movement in the high beta stocks, just because the return on the high beta stocks uh, was a lot, that does not mean that the return is coming through alpha. A lot of that return is being generated because of the fact that they are correlated with the markets and they're moving in line with the market. So the alpha might be the same, okay, which was 14% for all your high beta stocks and 13% for your low beta stocks. Okay, so they're not necessarily outperforming the market by so much. A lot of that movement really is a function of the fact that these stocks are high beta stocks. Okay, any questions on the class yesterday before we go ahead? Okay, great. So let's start with what we wanted to cover today. So typically, if you look at where we want to find alpha, and as a portfolio manager, that's the first thing that you'd want to do. Okay, you'd want to see how is it that you can beat the market. Where is it that you can? Sorry, yeah, where is it that you can find tools, or where is it that you want to find signals where you can beat the market? And whether it is a high beta or a low beta stock, end of the day, you're trying to capture alpha. So somebody who's in Nifty 50 versus somebody who's in Nifty 500, or small cap stocks, they need to figure out what is it that they want to pick up from within those segment of stocks that would help them outperform the market. Okay, so typically, if you look at the fundamental investors, they would look at value. For somebody who's using technicals, you'd want to look at, hey, uh, can I use moving averages? Can I use Bollinger Bands, channels? Do I want to play breakout? Yesterday when we were doing the introduction, a lot of us are using swing trading strategies. So all of them work. You just need to figure out how is it that you can make the best use of those tools to be able to ensure that you're able to pick up outperforming stocks and probably hold them to a level where you're able to outperform the market. In the in economic text, there is a lot of conversation around efficient market hypothesis. So there's a person by the name of Eugene Fama, who's the father of EMH, efficient market hypothesis. And the entire context of EMH is that markets are efficiently priced. And if the markets are efficiently priced, there is nothing that your past data would tell you that would help you outperform the markets. Okay, so what we're trying to understand is that, hey, can we look at past price data? Can we look at Bollinger Band? Can we look at moving averages? And one of the things that you need to understand is that all these are lagging indicators. Okay, so the price moves first, and then the moving averages are formed, and you would try and see if the prices are above the moving average, below the moving average. Where is it that the Bollinger Bands are? So these are all lagging indicators that will tell you whether to take a trade or not to take a trade after the price has already moved. So there's something that's happened on the price action, but you're taking a trade after that. There's nothing that, at least in the current context, that helps you predict how the prices will move in the future. Okay, and that's where efficient market hypothesis. This is a lot of there's a lot of research in the academic community that says that it is not possible to outperform the market. You know, there might be some people who've outperformed the market, but a lot of it really is just pure luck. Okay, but if you actually look at the performance of some of the best money managers in the world, what you'll see is that they have not only outperformed the market, but they've consistently outperformed the market, and that's where a lot of the academic studies by Eugene Fama and some of his peers is constantly being challenged because of the fact that not only TA, as you know, the fundamental analysts also who are actually able to outperform the market. So you'd have studied a little bit of efficient market hypothesis in level one. We had the weak form, strong form, semi-strong form, which spoke about historical prices cannot be used to outperform the market, or the historical plus public information cannot be used to outperform the market, or private information cannot be used to outperform the market. So depending on which model uh, is being used, uh, as per EMH, you cannot outperform the market even if you have some private information. But again, that's something that cannot be researched, that cannot be that cannot be proven, because insider trading is something that's illegal, and you don't have a lot of information about why somebody is buying the stock based on insider knowledge. So when we look at EMH, that is what is relevant in terms of the academic community. There's still a lot of courses that you see on finance which will talk about EMH and the fact that markets cannot be beaten. But end of the day, if you look at some of the new studies that are coming about uh, for adaptive market hypothesis and fractal market hypothesis, which we'll talk about, what they say is that there is some alpha that can be generated in the market. Okay, and when they mean alpha, what they're basically saying is that, hey, looking at some of the data points, looking at how the markets are behaving, looking at what is the value that's there in the stock, both whether it is technical or fundamental, you can figure out a source of alpha, which means that you can actually beat the market based on the research that you do. So Andrew Lowe is one of the proponents of AMH, and what he's basically saying is that financial markets do not efficiently adjust. Okay, now when what he means by that is that, okay, so if this is the price movement of a particular stock, and there is some information that's come in, the price will move over here, but this is where the final price point is. Okay, so somebody who's captured this move, great, they're probably holding the stock from the beginning, but this is the point that the news comes at. After that, this is the end state where the price should move. The first day movement was like this, but over a period of time, the price will keep going up and probably stabilize at this level. Now, for somebody who's using a trend following strategy, they can probably enter at the breakout of, suppose, this level. Okay, they'll probably get an entry somewhere over here, and over a period of time, they can capture some of these moves. You might not capture all that move, but because the markets do not efficiently adjust to the information, there is a window within which uh, people can go ahead and capture some of those price movements. So basically, based on the news, based on the new knowledge, people adapt to what is changing in the environment. Okay. At the same time, they also talk about cognitive biases that prevent people from taking some of those trades or probably taking the wrong trades. And we will discuss a lot about cognitive biases when we discuss, behavioral biases in one of the following sections. And we'll talk about what is it that we need to do to ensure that we don't let emotions come into play, and we really have a method to the madness when we are trying to take our trade. Something that I covered even yesterday in terms of manual trades versus algo-based trading, where in a way it has helped just remove all the emotions out of the market. If based on a rule there is a breakout on a particular stock or a particular commodity, the algo will take that trade. If you're trading manually, as long as you have the conviction to take that trade every time there is uh, a trade that needs to be taken, every time your setup is present in the market, you go ahead and take that trade. You are able to do that without emotions. You're able to maintain your position size and stop losses. You can do that manually. For me, what worked was that I let the system do it rather than trying to do it manually. And that's something that basically covers for a lot of the cognitive biases that come in. So really, what adaptive market hypothesis talks about is that the market goes through certain periods where there is information efficiency, but at the same time, there's some bit of inefficiency because it takes for the efficiency to play out over a period of time. Okay, wherever there is any bit of inefficiency in the market, okay, where the price behavior can be explained by cognitive biases, which means that people are still adapting to the new information. People are still trying to figure out what is the final price that the stock should settle on, or the securities should settle on. That is where there is an opportunity for whether it is a technical or a fundamental investor to be able to hunt for alpha. Okay, so if you look at fundamental investors, they try and understand what is the value that the stock has. What they're trying to target is that, okay, uh, I feel that the discounted cash flow over the next probably 10 years pegs the stock at 200 rupees, but the market today is pricing it at 100 rupees. That's what is the market efficiency that a fundamental investor will try to drive. uh, as a technical trader or an investor, you would say that, hey, every time that the price is moved above the 20 SMA, it has given a 7 to 8% return, and that's the inefficiency that I would want to drive. So what you do is take a trade as soon as the price crosses the 20 SMA. So there are different ways to generate alpha, but what Andrew Lowe articulated was that AMH basically is about the fact that there is a time delay for the prices to get to an efficient level. And during that time, there are ways in which investors can actually use the market data to be able to generate certain alpha. For the exam, please ensure that you remember some of these names, because they are direct questions on who are the proponents of certain types of theories. So just remember the names, understand what AMH is, and if you asked a question saying that what are the ways in which you can generate alpha, AMH or fractal market hypothesis would be the two options that you'd want to consider. Okay, so, and again, at a lot of places you will see throughout some of the theory chapters names of different authors, different studies. Just be aware of the author and the studies that they have done, because there are some direct questions that come in which talk about, hey, these authors, Stephen, Mark, and Michelle, what is it that which is the theory that they came up with, or what is that their study shows. So what they basically looked at was that when you're looking at the volume and price patterns around a 52-week high or low. Okay, what they're saying is that whenever the stock is above the 52-week high or below the 52-week low, they were able to see certain patterns at these price extremes that helped them make the decisions. So basically, what they're saying is that the magnitude or the effect of those data points are significant enough for somebody to be able to profit from, or you know uh, take a trade based on those information, based on that information or the events that have happened at that time. Okay, so even if there's no accompanying fundamentals, just the fact that prices are above or below the 52-week high or low, there is certain inefficiency in the market at that particular point of time, that somebody uh, who has a strategy based on the 52-week high or low, they are able to exploit those data points. They're able to figure out how to trade those 52-week highs or lows. And what I'll tell you is that if you look at different studies, you will see that people are exploiting 52-week high and 52-week low in different ways. But for the exam, you'll need to understand what is written in the text. Okay, what they're saying is that when the stock is trading at its highest 52-week price, okay, then traces to the lower prices over the course of a year or more, only to trade at the price that exceeds the former high, then there should be nothing about this new pinnacle that was not already priced in from the former fundamental information. So what they're saying is that if suppose this is the 52-week high for a particular price, okay, it goes up here, it traces to a lower level, suppose over here, okay, and if it exceeds that former high, there isn't anything about just that price that says that okay, something changed fundamentally for it to go from here to over here. And the key is that can you exploit an information like that? Okay, investors that are taking action based on new high and no other information, okay, they can build certain strategies that will help them create this kind of a market. So there would be certain studies that will tell you that hey, at this point of time, when you're at the 52-week high, prices typically retrace, and if somebody uh, who's trading the reversal, they would want to use the 52-week high as a point where they would take a reversal trade. Prices will come down, and as soon as prices start rising again, you'll exit at a particular point of time. Somebody who is trading a breakout, they would wait for this 52-week high to be taken out and then wait for the prices to move further ahead of that. So what they studied was that there are price patterns that happen at the 52-week high or low. Okay, that pattern is really because of the adaptation of people to this new price. Okay, and all of that is a part of behavioral finance, which basically talks about the fact that hey, if a price is at a 52-week low, I might go ahead and say that hey, the prices have reached a peak, I want to exit. Okay, there's somebody else who is following a different pattern, and they would feel that prices are at a 52-week high, and there is no resistance above that 52-week high. The prices might move further up. So the different ways in which people view those boundaries. Okay, so whether you're looking at support or resistance, whether if this is the support and if this is the resistance and this is the support, there are different people who take different trades at those points. And if you're able to uh, figure out how to optimize your chances at those levels, there is a better chance for you to generate alpha just based on the price movement, not necessarily even looking at what the fundamentals are. So information is the key really to generating alpha. Dr. Kobier was somebody who further looked at some examples that helped support AMH, which is the adaptive market hypothesis. And adaptive market hypothesis really is a function of the fact that market is based on emotions, and depending on what is the emotion or adaptation that the investors are showing, that's what will drive market prices. And what he really did was he looked at Pakistan's KSE, which is the Karachi Stock Index, or Karachi Stock Exchange. He looked at it to see what is the level of efficiency within the market. And what he was able to figure out is that the market is not a random walk. Okay, whether it is a weak form efficient or not. What he was basically able to show with data is that people can use technical analysis to generate returns that are higher than the market, and that in a way disproves EMH. Okay, based on certain rules, based on certain trading patterns, you are actually able to outperform the market, and that is where his study actually helped the cause of AMH rather than EMH. Okay, because EMH is something that is still there in a lot of academic texts. Typically what the proponents of EMH talk about is that because you cannot beat the market, the only way for you to make money in the market is just go with indexing. But if you look at the results of a lot of people in the market, whether it's Berkshire Hathaway, whether it is Jim Simons, different ways that they're trading. Berkshire Hathaway buys something that is at value and holds it for the long term. Jim Simons was somebody who would take a lot of trades based on certain quant research that I think it was the Millennium Fund, if I'm not mistaken, what Millennium Fund would do, and then take a lot of trades with very small margins, but still make money. I think when they closed on that fund, they had made about 65% year on year for the duration of that fund. So there are different ways, but the key is that are there are there opportunities in the market that are not in line with EMH? They are. Okay. There are several factors that contribute to market efficiency. Most of it really is based on the fact that how is it that investors behave based on the information that they receive. Most times, they're slow to incorporate the information that is provided by the market. There are a lot of times they jump onto a trade very quickly. Okay, so if Fed has changed the interest rates, or if there is an earnings announcement that has happened, they would jump into the market only to probably see that the market had already priced in that information, and prices start moving in the opposite direction. So depending on how people are incorporating that news, okay, they can be slow to incorporate the news also. There might also be situations. So let me just use this example. So I showed you an example of where, if this is the place that the market was trading at, there's an information that's come in, this is where it's gone to, but this is the correct level. So it will take some time to get to that level, and somebody who's using a particular strategy can probably trade this particular timeline to be able to generate certain alpha from the market. But there's another thing that also happens is that if this is how the markets were trading, okay, there's a news that comes in, this is where the prices have gone to, okay, and this is where it starts trading. But this is the real level at which the market should have been. So what happens is that over a period of time, prices will go up initially, but keep falling to come back to the right price level. Okay. Somebody who's aware of the fact that this is the correct price level would then take a short trade at this level to be able to come to the right price level, and then make sure that they're able to exit once prices reach the right level. And what happens in this second case, in this first case, is where people have not incorporated all the information. There's a delay in terms of prices reaching the right level. Over here, people have I would say, exceeded the right price level. There's been a lot of push for the prices to move above the right level. And then over a period of time, the price actually corrects downwards to the right level. Okay. So the conclusion offers a useful principle in identifying trends as a bonus. Okay. And typically that is something that AMH accounts for, because AMH really talks about the fact that uh, there are situations in the market which are based on what is it that people are doing with the emotions in the market, and a lot of the price discovery is based on emotions rather than just the fundamentals. Strong trends in the market are more slowly incorporate new information, and more likely to continue than reverse. Okay. But at the same time, the other example that I gave you is that there are times that markets overreact to an information. In that case, somebody who's taking a reversal trade would probably be able to do well. But in most cases, markets take in that information slowly, and there is an opportunity for a trend following investor to be able to incorporate that knowledge in their trading, and try to generate certain alpha. Okay. So this simple but powerful principle forms the foundation of a technical analyst to build new research and find strategies that can help them generate alpha. Let me stop over here, see if you have questions before I move forward. Anything on AMH?
So basically, sir, wherever there is an inefficiency, we have a opportunity. Is what uh, the point is, maybe.
That's correct.
Is
So
it correct
basically,
interpretation?
yes, you're right. Sorry, I don't have all my screens with me right now, so I don't know who's asking that question. So
Vipul, yeah.
yeah, Vipul, yeah. So yes, really, the way to generate alpha is to figure out what is the inefficiency in the market, and then try to exploit that inefficiency. I think there's a question in the chat box saying, how do we estimate the right level? Uh, Unfortunately, there's no right way to figure out what the right level would be. Okay. Now, the times, going back into my own experience, you would probably understand what the right level is. You can do a discounted cash flow. You can figure out that, hey, this is the right price because the PE ratio that is showing for the stock is only 10, but it should be trading at a PE of suppose 15, because the rest of the companies in that industry is trading at 15. For you, the right level would be that the price should move from 100 to 150, but the market would not recognize that. Okay. And the challenge is that you would not be able to generate any alpha till the time the market actually recognizes the fact that this particular stock needs to be at 150, because the current PE is at 8, and industry PE is at 15. So this is undervalued, and it needs to go to the price level of 15 PE. You can keep holding that stock till the time there's something that drastically changes. You'd probably not get that valuation. So there's no right or wrong. It's something that you'd be able to come to know with experience. Uh, and that's where, when I look at, somebody mentioned yesterday that they do techno fund investing. Uh, a lot of my strategies are also based on fundamentals and technicals together, because of the fact that, okay, if I understand that this particular stock needs to go to a particular PE, but do I want to put the money in right now and then be at the mercy of the market till the time everybody else recognizes it? Or do I want to wait for the market to first recognize it and then buy that breakout? Because what happens is that, okay, you've purchased a stock, this is where the 10p happens, but the stock can keep staying over here. Probably it will go down to a 8p also, and then suddenly, it will break out. It'll get to the industry level. It may not, but if you've caught it over here, what's happening is that you've saved all this time that you kept holding that stock just because of your own conviction. So there's, if you ask me, can anybody figure out the right level? It's really a function of what the market believes in. Can I tell you today that uh, Nvidia is at the right level in terms of what should be the future earnings, I don't know. Okay, but as long as the prices are going up, uh, you know, or for that matter, if even if you take Bitcoin, okay, is there a right level for Bitcoin? I don't know, but can I trade it based on the patterns that I see on the Bitcoin chart? I can. Okay, so yeah, coming back to the question, it's really a function of how the market is pricing it, and that's where if I look at a lot of my own technical research, I feel that it's you cannot just go with a level and say that this is the right level, and just because you believe it, the market will also understand the same thing. It doesn't always happen, and that's where if you mix your fundamental research with your technicals, it always gives you a better long-term outcome than just looking at one or the other. Okay, so I hope that that helps. Perfect. So let's go to FMH, which is fractal market hypothesis. So again, another author, Edgar Peters, he was the one who articulated fractal market hypothesis. And really, if you remember the concept of fractal from level one, what it says is that at different, at any specific time horizon, market patterns would behave in a similar manner. Okay. So what he did was he published a paper in 1994 or a book in 1994 called Chaos and Order in the Capital Markets. And typically, what that spoke about was how do investors behave in a period of crisis. Okay, he looked at the fact that people have different time horizons, different risk tolerances, and because of that, the reaction would be very different. Okay, so if I have a 5 year view on the Indian market, I'd probably still be investing in small cap and long mid cap. Okay, but somebody who's looking at the next 1 month, probably not the right thing to do right now. Okay, because we don't know how much lower uh, the market will go from here. Okay, and that kind of reminds me of something that I read recently. So there was a technical analyst and a fundamental analyst who were in the kitchen, and a knife falls from the kitchen table onto the fundamental uh, uh, analyst's foot. Okay, and it drops and it goes through his feet, and obviously it hurt a lot. And he asked the technical analyst, why didn't you catch that knife? The technical analyst said that, hey, I don't catch a falling knife, that's why I didn't. But why didn't you move your foot? Okay, any idea what the fundamental analyst said?
He didn't thought that the knife will come so down, maybe.
Yes, I didn't think the knife would go down so much without reversing. Okay, so there's no right or wrong answer for what the right level is. It's just about what is that the market is willing to pay you for that, and really making sure that uh, when we are in the market, we understand some of these and build uh, our own strategies based on something that works for us. Okay, I can tell you my strategies. You can pick up a strategy from any of the books. You need to be comfortable with what makes sense to you, because if you'll not be able to hold that trade. You'll not be able to sleep comfortably once you've taken that trade. And that is something that's very important, because if you don't, then you're always fighting against the market, which is not the ideal thing to do. So coming back to fractal market hypothesis, investors do not make decisions based on an aggregate of all the historical prices. Okay, but everybody is looking at a different set of information. Okay, again, going to the example of different blind people trying to figure out what the elephant is. Okay, somebody who's holding the tail, somebody who's holding the trunk or the feet, they would look at it differently. And that's true for even investors who are using different time frames, people who are using different trading methodologies, people who are using different strategies. There's some there's somebody who's obviously using trend following. There's somebody who's using a reversal, and they would feel that, hey, the RSI is above 85 now, it needs to reverse. Somebody who's a trend follower, he would be like, okay, now the RSI is above 60. Now, I'll probably stay with this particular trend. The different ways people look at it, and that is the reason that there is a lot of uncertainty in the market. Okay, so you don't always have everybody doing the same thing. When enough investors perceive the market in dissimilar ways, okay, and also disagree on what the market is telling them, there is a lot of instability and volatility goes up. Okay. Now what you'll see is that people coming on CNBC or anything that you follow uh, would come and talk to you about why something has happened, and unfortunately nobody knows. Okay. You can go and talk about anything with hindsight, give all the information because Trump did this what is what happened, or dollar moved in this direction, this is what happened. In a lot of cases people just don't know. They're just trying to put a hypothesis to make the channel look good for people to get eyeballs. uh, as a CMT professional, one of the things that I'll advise you on is to try and build your own hypothesis on things and see if it works for you, because using somebody else's hypothesis and somebody else's research won't help you build your own conviction. So if you are somebody who's just starting off and trying different things, start with a small capital, try and see if your hypothesis actually works. And again, not that it works 1 day or 2 days, whether it works in the long term, because there's no one trade that will make you a lot of money, because if there is one trade like that, you're also risking a lot of that money. Okay. You need to be able to earn from the market each and every day. So there'll be days that you'd even lose, but take your time to figure out what is it that works for you before you jump in with a higher position size and with a lot of capital. So Edgar Peters, okay, his proposition of FMH established the possibility that whenever there is uh, the instability or volatility in the market, that actually is a rejection of EMH, because this leads to the possibility that people can capture some of those movements. They can predict the price and probably generate alpha. Okay. This research has been taken up by other researchers also, with a lot of corroborating evidence that says, whether it is looking at wavelet uh, wavelet power spectra, which is a way to look at some of the cycles. Okay, there's also something called Markov's regime of switching models, where they figure out uh, when is it that the market is overpriced, when is it that the markets are underpriced, and that kind of tells you that, okay, this is when you probably need to go long or go short. Remember what is Markov's regime. Remember what uh, wavelet power spectra is, and really the fact that how is it helping FMH. Okay, so these are additional studies that are in line with FMH, which talk about the fact that markets can be beaten. Okay, there is a way to figure out inefficiencies in the market, and they, in a way, disprove what EMH is telling us. Then there's also a very simple thing that all of us know, and some of you who've studied microeconomics in school or college would know about supply and demand. So really, if you look at the prices of stock, a lot of it depends on supply and demand. It's really based on what is the liquidity in the market, how is it that the investors are perceiving the market, and what is the willingness to buy securities. Okay, if there is a lot of liquidity where the Federal Reserve has reduced interest rates. They've pumped in a lot of money into the market. Not a lot of that money goes into actual production, okay, where somebody's setting up factories. Any excess money that's left would go and try and buy financial assets or even real assets. Okay, in 2007-8, or all the way from 2005 to 2007, people were putting that money into real estate. Okay, uh, in 99, 98, probably all the way to 2000, people were putting that same money into the stocks of dot coms. So really, supply and demand is a big factor that will tell you what will happen to the price of securities. So the concept of supply implies that investors have a lot of securities that they're willing to sell, so much that they're likely to drive the prices down. Okay, if you look at what's happening in India since 27th of September, when we had the peak, a lot of foreign investors have Indian securities, but they prefer to move that money into the US market where they're getting a higher return, or probably even the fact that they feel the Indian markets are expensive. They have a lot of security that they're willing to sell, even if that means that they're able to drive the prices lower. Okay, so there is a significant gap between the concept and causation. There is always a challenge between demand and supply, and that kind of drives what security prices are. Okay, now uh, when you look at supply and demand, one of the things that is very pertinent is the fact that we always feel that there are a lot of sellers that come into the market, because of which the prices fall. But if you actually understand how markets behave, it's not a presence of sellers that drive the markets down, but it is the absence of buyers. Okay, so if there's somebody who's willing to sell at 100 and there's nobody willing to buy it at 100, that person has to go down to 98. If there's nobody who's willing to buy at 98, that person has to go down to 96 to be able to sell that particular stock. So one of the things that you realize, if the price stays at 100, that means there is a buyer and a seller. If the price stops at 98, that means there's somebody who's willing to buy that particular stock at 98. But if there's no buyer at 98, that is when the prices will fall. So the fact that prices are falling is not so much a function of just the fact that there are more sellers coming into the market, because at each price point there is a buyer, there's also there is a seller, and there's also a buyer at that price point. Only then that price point shows up in the chart. Okay, but if there's no buyer, that is where the seller needs to keep going down till they get to a price where they meet a buyer. Okay, is 20, I think 22,800. Yeah, so we've moved up from 22,800 several times now in the Indian market. Is that a place where the support will hold? Probably. But tomorrow, if there's nobody who's willing to come in and buy at 22,800, that is where that support structure will break down. Maybe if there are a lot of buyers that keep coming in at 22,800, that support will hold and prices might move up from there. But one of the things that you need to understand is that, again, a lot of people on TV talk about the fact that, hey, there are a lot of sellers that are coming in. It's not the sellers that are driving the markets down. It's just that there's nobody willing to buy at that particular price. So if you look at the DIIs, they have a lot of money sitting in cash, and can they, go ahead and keep the prices at a particular level? They can, but they probably do not want to give an easy exit to the FIIs who are trying to exit the market, and that is the reason for the fall in the market. Otherwise, if you look at it, and if you actually look at the data, there are several days where the DIIs have bought more than what the FIIs have sold, and the only thing is that they're letting the prices fall because they're getting a better opportunity to enter those particular stocks. So a lot of what you see versus what the actual data shows uh, is uh, is not entirely accurate. What you hear on TV or what you hear on YouTube channels, you need to go deeper and understand how the market prices behave to be able to actually figure out what is the right construct that will work for you. So let's talk about supply and demand and how that works with EMH, and what are the contradictions that are there. Okay, so just remember this table. I think this table is there in the book also. Uh, so there's few anomalies in the market that cannot be explained by EMH, and the first one of that is correlation between return of a group of stocks or securities. So if Infosys is moving up, there will be situations where TCS is moving in the same direction. Okay, if an Apple is going up, probably even something like Microsoft will move up. So the fact that prices of similar stocks are correlated is not something that EMH can explain, but all of us can see that actually in the market. Okay, if you look at the Max 7 stocks, all of us are moving, all of those are moving up together or moving down together. Okay, Nvidia might have overtaken a lot of them, but there might be a point where the market would feel that hey, all the Max 7 are overvalued, and they would start moving down together, or maybe they'll keep moving up. Either ways, but this is something that EMH cannot explain, why prices of similar stocks or correlated stocks move together. Okay, because as per EMH, markets are efficiently priced. Only new information about that specific stock should move the prices. Then there's this concept of mean reversion. Okay, so what I showed you in the example, that you have a stock that's gone up, but then reverts to the right price that it needs to be at. Now, again, mean reversion is not something that EMH can explain, because the market should not be efficient in the first place as per EMH. So, if this is the right price, market should not have gone above this, because EMH says that the market will always be efficiently priced. Similarly, the other example that we had, underreaction to the news, where the market has moved up till here, but this is where it needs to go. It will keep moving up over a period of time. Again, this is something that EMH is not able to explain, where as per EMH, as soon as that news comes in, okay, and this is how the prices were moving, this is where the prices need to be. Immediately after that, the price should be trading at that level, but that's not how it happens. There is a lot of an underreaction to the news. Prices take time to reach an equilibrium level. Then we're coming to some of the fundamental investors, models, fundamental investor models. The first is the size effect. Okay, what data has shown is that when you're looking at smaller stocks, okay, they tend to outperform larger stocks. Okay, even accounting for the higher volatility. So, if I again take the example of what happened in small cap, the small caps moved much faster than large caps throughout probably 2022, 23, 24. Okay, obviously they went down further, but at least while the market was going up, you could have traded those stocks you could have traded those stocks long and probably made more money compared to the large cap. Okay, and if you traded them short as they were falling, then you probably would have made more money than shorting some of the Nifty 50 stocks. We spoke a little bit about the PE ratio. Okay, now stocks with lower PE tend to predict greater outperformance. Not always, uh, yeah, greater outperformance, but not always. The key over here again is that if you're able to figure out what works for you, whether you want to use large cap versus small cap, whether you'd want to use high PE ratio versus low PE ratio, all of them can lead to certain outperformance. And these are things that EMH is not able to explain. If you're able to use that right, there is certain amount of alpha that you'll be able to generate. You have the January effect, okay, which is really called the Santa Claus rally. which typically starts towards the end of December and continues through January. Uh, the actual explanation for these stock for the January effect is the fact that people want to book their profits towards the end of December, and then again want to ensure that they build their positions starting January. Uh, and that's where the prices of stocks typically rise in January. It happens most of the time, it doesn't always happen, but there's enough data to show that the January effect is present. And people can use that opportunity to try and outperform the market, where you're probably placed in the stock when prices have fallen to a particular level in December, and then ride it through January and exit probably towards the end of January, or probably even hold those stocks if they do not show a reversal. And then obviously the fact that there are a lot of patterns in volatility. Okay, uh, bear markets are more volatile than bull markets. Okay, and if you actually go and research the data, what you'll see is that some of the biggest moves in the market, okay, and I'm talking about upside moves, have happened in a bear market. And the reason being that if prices have fallen on a particular day, you'd see as a percentage a much higher rise during the bear market than during bull markets. In bull markets, what will happen is that prices have risen over here, go up again, and slowly it will keep rising. There will be some level of stability to the rise, but the fact is that there are patterns that can be exploited both in a bear market as well as a bull market, and that again goes against the entire theory of EMH. So remember all these different anomalies that cannot be explained by EMH. You might have a question around, out of either selecting one of these, even a true or false, whether this is something that can be explained by EMH or not. You need for the exam, you need to remember each one of them, and also the explanations that go in as to why mean reversion is something that cannot be explained by EMH. Why is it that the size effect is something that cannot be explained by EMH? So with that, we come to the end of this particular chapter. Any questions?
So in latest the soft copy
Mhm.
syllabus which we see, we do not have this table as such, but I mean it is great to know, um, to help us to understand the limitation of EMH and the reasoning behind it. But my question is more in terms of if we have an Excel file wherein we can compare the old versus new chapters in detail, which will help us. Uh, how can I say? Because see, in latest there is no hard book as such, but
Mhm.
few of us are more say inclined towards reading from say hard books. So
Mhm.
if we take even previous curriculum hard books, and if
Right.
some of the questions are say or other chapters are repeated from there, at least
Mhm.
we can refer those from hard books if we have that comparison.
Mhm. Okay, so what you're basically looking for is that if there are chapters from the 2024 syllabus that are the same in the 2025 syllabus.
Yeah, that will help us to refer the hard books at least for that content.
Okay, I'm just thinking through that. Yeah, I think that's doable. When we are actually creating a lot of the new content, we did do a little bit of study. We might not have put it in an Excel sheet, but that is available in terms of what are the things that are coming from some of the earlier content. And the two things that have happened, one, obviously a lot of content has been reduced in the new syllabus. At the same time, there's been some content that's moved from one level to the other. So let me see what we can do, and make sure that we have that for you on the Yubha website.
Thank you, sir.
Okay. Uh, any other questions? Okay, so let's take a 5 minute break. It's 10:59 by my watch. We'll come back at 11:05, and we'll start with the next chapter, which is 1.2 fusion analysis. Uh, and that chapter really talks a lot about how is it that we can integrate technicals and fundamentals to be able to get the right view on what is happening in the market. Okay, so let's take a 5 minute break and come back.
Thank you.
Okay, we're back. Just give me 1 minute to get the new chapter on, and then we'll start.
In new syllabus also, sir, the table is there. It is my bad. So I have not
No,
went through it properly.
yeah, no, no,
Yeah.
that's fine. I think, yeah, that's what I was thinking because I wouldn't have captured this table if
Yeah,
it
yeah,
was. It
yeah.
was
Because in image, I mean, there was loading error, so it was
okay.
taking time to load. Yeah, it is there.
No problem. No problem. And wherever while you will get a PDF version of everything that I'm sharing uh, with you, but you can always take a screenshot, whether from the live class or even from the video. That will help you make sure that you have anything that I've captured in the class. Okay, perfect. So we're now coming to the syllabus. Sorry, the chapter on fusion of both technicals as well as fundamentals. Okay, how is it that we can team up with fundamental analysts and make sure that as a team there is a greater alpha that we can capture in the market. So what does a fundamental analyst do? Really, if you ask me, uh, they look at what and why. Okay, what is it that the stock will do? Why will it do that? Okay, a lot of technical analysts, they don't necessarily care so much about the why. In most cases, if the prices are moving in a particular direction, you'd go ahead with that particular trade. If you've seen a breakout, you would take that trade. Obviously you'll have a stop loss, and if the breakout fails, then you'll exit. But uh, as technical analysts, we don't necessarily consider the why so much, as much as a technical as much as a fundamental analyst would. Okay, so typically what they do is they look at a lot of data, they look at a lot of public information, they speak with the management, and then they try and figure out an estimate of what the future of that company is, whether it is in terms of revenue, whether it's in terms of P&L, whether it is in terms of cash flow. They look at all these factors to figure out what is it that the company can do in the future. Okay, they try and use all that information, okay, both historical information as well as the future projections, to figure out what is the enterprise value of that particular stock, which means what is that the company can uh, you know so what is the value of that company right now, which is not only the market cap, but what is the long term debt, what is the equity, what is it that the company can earn over a period of time, so that you figure out what somebody should be willing to pay to acquire that company. Okay, so basically what they're trying to say is that, hey, the market cap today for that company is suppose 100 million, but based on what it can generate over a long term, it should be at 150. Are people willing to pay that kind of money? Okay, the challenge really is that a lot of times when you look at the earnings, you look at the targets that a fundamental analyst comes up with, they are often adjusted and can also be changed. Okay, all the fundamental analysts really look at historical information, okay, because that is the only thing that they have, and most of that historical information is published. Using that historical information, using their understanding of the company, they come up with future projections, and again the future projections can also be changed. The problem is that the past information also undergoes certain changes. Okay, so you need to understand accounting to be a fundamental analyst. You need to understand the income statement, you need to understand the balance sheet and cash flows. And really, if you look at it, these are the three most important things. As you look at a company, more and more focus is being given to the cash flow rather than the balance sheet and income statements, because there is a higher chance for the income statement and the balance sheet to not reflect the correct status of that company, depending on your accounting, the accounting tools that you bring into play. And most of the analysts today, you know, give higher reliance to cash flow than to the balance sheet and income statement. And typically, they would want to look at all the three. But if there's something that's wrong with the cash flow, then that is a serious no-no in terms of touching that company. Okay, the income statement and the balance sheet might show anything, but a lot of that can be manipulated based on how the accounting measures are. So, while some non-accountants may not realize that the annual reports of publicly traded companies are filed with SEC, the annual reports are only reasonable estimates. Okay, as I mentioned even yesterday, that a lot of these are based on estimates. Even for a company, you won't be able to know uh, what is their final status. They might have a lot of goodwill on their balance sheet. They might have accounted for inventories in a particular manner that reflect a higher or lower valuation depending on what they want. And because the financial statements can be restated, okay, it's very difficult to figure out the current status, as well as compare different companies just based on their financial statements. And that's one challenge, and that's the reason that a lot of analysts today have reduced their reliance on income statement and balance sheet and focused more on cash flows, because this is something that is can be manipulated, but it's a little more difficult to manipulate because you're actually seeing what is the money that's coming in and going out, rather than trying to say that, hey, depreciation should have been at 15% per year, but you're only taking 7%, which is showing a higher profit and loss, higher profits. So those are things that can be manipulated, and that's the reason that there is a higher reliance nowadays on cash flow rather than just the P&L and balance sheet. The other challenge is that each company has their own accounting methodology. Okay, and another reason that you cannot just compare what is it that is going into the financial statements, and that makes it difficult for us to figure out what is the correct comparison. How is it that one company can be compared against the other? And what happens in that entire scheme of things is that as things get restated, the uh, the actual price, or the estimated enterprise value of that company keeps changing. Okay, and as the enterprise value changes, the analyst would come and change your stock price target also. So suddenly in the last quarter, based on what they saw, the price was 150. In this quarter, they would look at it and say that, hey, your earnings have slowed down. There is a slowdown in the economy, and now I only value at $80 or $100, whatever that is. So there is a challenge with a lot of the statements that are based on fundamental analysis. One, because you cannot reasonably estimate what's happening in the future. Second, even the historical data can be changed. Uh, while the basics of accounting and model preparation are similar, regardless of the sector, it is impractical for somebody who's a fundamental analyst to be able to look at various different industries, because whenever you're doing fundamental analysis, you have to study that particular sector and the company very deeply. And because the depth that you need to go to is so much that you can probably specialize in a particular sector, or maybe two or three sectors at the most. And when you look at a lot of analysts for even some of the big fund houses, some of the big hedge funds, they would have analysts for each of the major sectors, and all that they will publish are reports based on what is happening in that sector. Okay, so each sector obviously has several thousand traded companies, and one of the challenges that happens is that as a technical analyst, you can go across multiple sectors. You can use the same tools same chart patterns, whether it's Bitcoin, whether it is energy, whether it is Forex. But on the fundamental side, you have to specialize in a particular sector. If you're doing energy, if you're doing metals, if you're doing agro commodities, or even telecom stocks, whatever you're doing, you specialize in that. And probably one of the reasons where there is more employment opportunities for fundamental analysts, because somebody who understands telecom might not understand energy, and vice versa. So that's one of the challenges with just the number of roles. And also probably there's a lot of work that we as TAs need to do to make sure that there is greater appreciation for TA as the right tool to be able to figure out the alphas. And I think the other thing is also the fact that a lot of people who consider themselves TAs without having the right certification and the right learning, there needs to be a way in which those folks can be eliminated. So really, when you look at TA, the primary thing that we focus is on the price. Okay, what is it that the price is telling us? Okay, buyers, sellers, sometimes we add volume along with the price, and that also takes into effect investor psychology. Okay, we only focus on the when and where. Okay, did the breakout happen, at what price? We don't care about why. Okay, if the prices moved above the SMA, when did it move above the SMA, and at what level, and we'll take that trade. We don't really care about why the prices moved above SMA, and the fact that there's something that happened with the Fed, or there's something that happened with the weather, because of which there's greater demand for energy or something. We don't really care about why that is happening. All that we care about is that what is it that the price is telling us. Yes, sometimes we add volume to that because that gives us greater conviction of where the prices are going. And are there more people who are going in the direction of the price or not? That's something that volume tells us. But the key is that we don't really care about the why. We only focused on what is the price telling us. Okay, so we use different tools. Obviously, we use charts to forecast future price trends. We build indicators based on what the prices are telling us. Now, the biggest thing is that you are asset class agnostic. Okay, you don't care which asset class is it that you're trading. Okay, you can be trading commodities, you can be trading Forex, you can even be trading yields, okay, which is basically debt instruments. You can be trading a bond. Okay, you can trade Bitcoin, and you won't care as long as you have a price, you have time, you have some volume information. That's all that you need. Okay, so you can look at soya beans, you can analyze oil. Okay, in the morning I use the charts to trade Nifty, Bank Nifty, and my trading goes on till about 11:30 or 11:55 during the winters, where the commodities market are still open. Okay, if I was allowed to trade Forex, probably the Forex markets are open till 5:30. So I would be trading Forex also. So I don't care what is it that I'm trading, as long as I have price and I have volume information, most of my trades will take place. Okay, so I start the morning trying to see what's happening on the indexes, what's happening on the stocks. Um, you know, my markets don't close at 3:30 because I also trade commodities that go on till 11:30 at night. And obviously, uh, because I don't sit in front of the screen, uh, I don't have to constantly monitor the market. Otherwise, my day would start at 9 in the morning and go on till 11:30. Uh, it is the algos that are taking the trades. But the key is that I can trade virtually anything where I have that little bit of information in terms of price and volume. So the fundamentals of a security or asset class are reflected in the market price. Okay, and this is something that's very important. Conceptually, if I look at what technical analysis is built on, is just the fact that everything should be reflected in the price. Okay, if there is some fundamental information that is there for a particular company, that should show up in the price. Okay, if people feel that the company is doing well, then the prices will rise. Okay, if they feel that, hey, the company is not doing well in terms of its fundamentals, uh, the amount of revenue that they're generating or the amount of profits that they're generating is actually going down, that should again be reflected in the price. And just by looking at the price, I should be able to figure out, hey, this is what I want to do with that particular stock. Okay, you also need to look at the liquidity of the market. And if you're trading the market, especially if you're trading stock options, just be very careful about liquidity, because if there is low liquidity in any instrument that you're trading, uh, as a retail trader, you'd always be at the risk of spread, which means that, if you buy a particular stock at 110, uh, you the next selling price would not be 110, it will only be at 108. If and you have a $2 spread that is there for that particular stock, so you'd never be able to sell it at the right price. So if there is something that has low liquidity, just be very careful. And typically, if you look at some of the stocks that are there in the F&O market, uh, most of the futures are also illiquid in those stocks, except for some of the large ones. But if you go out of the market in terms of out of the money options in stocks, there's very little liquidity, and that is where there's a huge challenge in terms of getting the right price. Sometimes if you go out of the market, you might not even get the intrinsic value. So suppose you have a strike price of 200, okay, and you have a call option with a strike price of 200, and the stock is trading at 250. What you'll see is that you can only sell this at probably 40 rupees premium. You won't even get the 50 rupees that you should get, because the stock is already 50 rupees ahead, above this uh, above the strike price. Okay, so just be careful about a market that is not liquid. And as a retail investor, I would not uh, advise you to trade in something that is not liquid. Okay, and if somebody who's actually following the price patterns, what you'll see is that a lot of these prices, these 40 rupees, is driven by algos. So somebody who's running an algo, they would keep, trying to ensure that they put a trade that is one lower than the intrinsic price, but at the same time, if you've put a price that is 41 rupees over here, they would come and put 42, so that if there's somebody who's trading this particular security, the algo price will hit first. So there are a lot of these things that happen in the market, and it's not only the Indian market. It will happen everywhere where there is less liquidity, where people come in and try and exploit that low liquidity situation. So what happens is that as a technical analyst, you can actually be able to see a lot more than things that a fundamental investor will miss out. Okay, because you're only looking at one parameter, you're looking at the price. And if the price moves, then you'd figure out what you want to do with that stock. A fundamental investor will have to wait and see why that price is moving, probably do a lot more research. And sometimes they would also miss out on certain things, which as a technical analyst, you'd probably be able to catch, because you were just looking at one single aspect of that particular security and then just trade that. A good company is not always a good stock. Okay, and let's understand the difference. uh, the company and stock are two different things. Okay, if I look at Vodafone, good company, probably not, because of the amount of debt that it has. Good stock, maybe if I feel that I don't know where it's trading at right now, but probably 8 or 9, somewhere in between, uh, that 9 rupee will go to 18. A very good stock, but not a very good company. Okay. Similarly, if I look at Asian Paints, a very good company, but if you somebody is tracking the Asian Paint stock, not a very good stock, at least right now. Okay, it was a very good stock probably till about 5 6 months ago, before a lot of investment came into the paint sector. But whenever we are looking at some of these things, again, we need to understand that the company and the stock can move in different directions. Okay, even when the earnings are good, okay, it need not mean that the stock prices will move in a particular direction. Okay, uh, in most cases, when the company gives a higher guidance, they give in higher profits, the stocks will trade higher. In most cases, when the company misses their guidance, the stock should trade lower. But there would be times where you actually see that, hey, the prices are trading over here. Company has given a very good result, but the prices have still gone down. Okay. Now, as a technical analyst, would you be trading long over here or short? Okay, it really depends. Okay, it depends on the fact that uh, what your understanding of what has actually been priced into the market. But at least if you are at this particular point of time, and suppose you are a trend follower, you would not trade this stock long till the time there's a breakout in the upward direction. You'd only wait for that price breakout to happen first before you enter that trade. And if the price goes down, then there's no trigger for you. Okay, you don't try and enter that stock on anticipation that, hey, this stock will move up. You wait for the market to tell you what it is doing, and then try and enter that stock. And there would be times that this is how the stock is moving, given you a breakout and then it goes down, and this is where your stop loss should be. If you entered over here, you take this amount of loss because the market did not continue in the direction that your trade is positioned in, and you need to take your small stop loss and get out of the market. So the instances where the company does have great results, it beats expectations, but the stock still goes down. Okay, or there are times that the company has very low guidance and the stock moves higher, and all these things happen in the market. uh, if you look at a lot of stocks, there is a very good earning. You suddenly jump into the stock thinking that you'd make a little bit of money uh, trading a uh, trading a quick entry and exit, but as soon as you enter, the stock starts going down. Okay, now part of that is what is built into the market and what is built into the prices. There's a saying in the market that you buy the rumor and sell the news. So if people feel that the company will exceed expectations, a lot of times the prices will go up before the actual result. And as soon as the result comes out, and if it is in line with expectation, people will want to book their profits, and stocks will start going down. Okay, similarly, if you look at even the Fed meetings, okay, the Fed comes in and reduces the interest rate. But if people had already been expecting the Fed to reduce the interest rate, then either the market will not change, okay, because that's already priced in, or people, if the market had priced in a little more, then the market will start going down instead of going up. Okay, so a lot of times when people trade news, they trade the anticipation of the news, and when the news actually comes out, they try to book their profits. Okay, both fundamental and technical analysts look at the same entity from different perspectives, and there's no right or wrong. It's just the fact that what is that works for you. If you are somebody who can go do deep research, figure out, want to focus on a particular industry and only trade stocks in that industry, great. Fundamental is good for you. If you want to have a very diverse portfolio and be able to trade a larger number of securities, probably technicals is the way you'd want to go. So let's understand what is that the technical analyst versus and a fundamental analyst look at. Okay, so on the top you have what is it that the fundamental analyst looks at. Okay, they look at the what and why. to understand what is it that the stock will do. They look at competition. Okay, Michael Porter and his five forces. Okay, so what is the competition doing? What is it that the industry is doing? They look at the P ratio. They look at products that the company has, if they have a moat or not. They look at how good or bad the management is. They look at balance sheet, uh, and then try to determine what is it that the company will do, and figure out a valuation for that company, and then see whether the price that the company is trading at today is lower or higher than the price that they have arrived at. If it is lower, then they would buy that stock. If the price today is higher than what the company should be trading at, they would typically short that stock. On the other hand, the technical analyst looks at volume, okay, price and volatility. They also look at risk, supply and demand, the liquidity that we spoke about, and also the psychology. Okay, is everybody jumping into the market? Are there a lot of new IPOs that are coming in? A lot of new IPOs basically means that promoters are exiting the market, and promoters would only exit the market if they feel that the market is valuing their company at a much higher level than what they feel the company should be valued at. Okay, so all that is what a technical analyst would look at, and psychology is something that we'll talk a lot about when we look at behavioral finance. But all this goes into how the company ultimately ends up being priced. Okay, there would be people who would be coming from a fundamental lens. There would be people who would be coming in from a technical lens. The mix of what a fundamental analyst thinks about the company, what a technical analyst thinks about the company, would determine what is the company's final price. Okay, the key is that both of them use historical data. Okay, there's you know you don't necessarily have future data anyways. What you are really doing is you're using the historical data to figure out what the price estimate should be in the future. Okay, so the data that you actually have is only historical data. There's no future data that you can have. Okay, the future is just based on estimates. Okay, the difference is that technicians rely more on past data than fundamental analysts. Why? The fundamental analysts, while they're using past data, their basic determination of what the company will do is based on forward looking guidance. Okay, and as we discussed earlier, one, they're an estimate. Two, the bigger challenge is that they change every quarter. Okay, till about September, everybody felt that the Indian markets will keep going up. We are decoupled from what is happening in the rest of the world. FIs no longer can determine the direction of the market because there's so much SIP coming through that the markets will keep going up as people put the SIP money into the markets. Uh, that narrative changed very quickly. Okay, as soon as the second quarter results started coming in, uh, maybe the FIs would have sold irrespective of the result. Okay, it just became a good narrative that the Indian growth slowed down, the government capex slowed down, and that's why uh, the Indian markets, are overvalued and they need to go down. The key is that those narratives are built after the market started falling. There are very few people who were able to say that the markets are overvalued. Be careful. Okay, and typically sometimes that's all the information that you have, and as you start reducing your positions at the top of the market, you'd realize that sometimes the market would keep going up, and you feel that you should have stayed invested in the market. So you never really know, but the key is that you need to build certain tools and hypotheses based on which you would want to uh, stay in the market or probably take some money off the table. From a technical point of view, uh, using historical data, but a fundamental analyst also uses historical data, but their assumptions are based more around what they think the future of the company is. Okay, the problem is that even corporate earnings can be revised and also be restated, and that is where a lot of what fundamental analysts look at, they're always challenged with the fact that they'll have to go back and redo all their calculations if something changes. Okay, if there's a company that's saying that they're looking at a 25% growth year on year, and they change it to 20%, suddenly all their calculations in terms of the valuation of what that company is will change, because earlier they were pricing it based on a 25% growth year on year. Now suddenly they need to price it at 20%, which would probably command a much lower price for that particular stock compared to something that is moving up at 25%. And as I told you, Ralph Akinpura always talks about the fact that price is a fact, but earnings are estimates. Okay, if there's a price that's plotted on a chart, there is an actual trade that has taken place. Okay, it's not something that will come out of the air. There's somebody who's willing to buy, there's somebody who's willing to sell at that particular price point, and that cannot be changed. Okay, if once there's a purchase and sale that has happened at a particular price point, that's true for that particular stock or that particular security. Okay, and let me actually show you an example that I had pulled out of what happens if that price is not really a fact. How many of you are aware of what happened to nickel, to the nickel market, in 2022? Is anybody aware of that? Anybody? No?
No.
No, sir. No, sir.
Okay. Let me just show you. I'll show it to you on a chart. Yeah, trading. Okay. So I was actually trading the nickel market for a long time, and probably all through 2022 and all the way from 2020 to 2022. If you look at, and this is the daily chart of nickel futures, you can see my screen. Okay, just look at what happened over here, February, somewhere over here, all the way till over here. Okay, what was the big incident that happened in February 2022? Okay, just Google it and you'll know. So basically what happened in 2022 was the Ukraine war. And what happened in the after that was there was a disruption in nickel supply, which pushed the nickel prices from somewhere over here, which was 1800 in the Indian market, all the way to 5000. Okay, each 1 rupee movement in nickel is about a 1500 rupee move in the price of one contract of nickel. Okay, one contract at that time probably was, you needed a margin money of 1,50,000 for one contract. Okay, 1500 into 3786. Okay, somebody who's holding one contract of nickel at this point over here at the bottom and held it till the top would have paid 1,50,000 as margin money, would have made about 57 lakh in terms of the in terms of one contract. Okay, the reverse is equally true. Somebody who's holding a short position with 1.5 lakh margin would have lost 56 or 57 lakhs on that one contract. Okay, it's that's what happened really, and this was just over a matter of 1, 2, 3, 4, 5, 6 or 7 days. Okay, there was a short position. I think one of the Chinese traders who had a large short position on nickel. Okay, and this was on LME, London Metal Exchange. So just Google that and you'll find the story. But to give you a gist, this person was losing a lot of money, and there are people who were long nickel. They made a lot of money, but the exchange went ahead and cancelled all the contracts or all the trades that happened on nickel to save this one trader who had short positions, because if that trader went under, there would have been problems one for the exchange themselves, and for a lot of the banking institutions who had loaned money for that particular trader. Okay, obviously once LME canceled all the contracts, suddenly the prices dropped. Okay, but there was a problem with the fact that people were not able to, there was a loss of trust on LME. And if you look at nickel prices after that, okay, and you look at the chart, okay, there's no trade really that happens. Nickel prices open up at a particular point of time, and a lot of the metal trade is actually moving from LME to other mercantile exchanges. Okay, so if you actually look at nickel prices, you can see that, and these are daily charts, right? And there's only one price point on the daily chart, which is not the way chart needs to look. So just read about it. But this is what happens if there's a loss of trust. There is a price where the trade actually happened on that particular day, and then LME going ahead and canceling all those contracts, results in a loss of trust for the traders. So you would see a lot of the metal contracts moving away from LME, and over a period of time. So right, most of it is on nickel, but over a period of time, a lot of other traders will also move their business to a particular exchange where they are able to ensure that the prices reflect exactly what has been traded. Akshay, will just elaborate your question on the kind of moves, which is the example that you're talking about. Are you talking about nickel? Just unmute yourself.
Yes, sir. On nickel only.
Just elaborate that question. What do you mean by the name of these trades, or what do we call this kind of move in TA?
Like it went sir 3x. So I just wanted to know, is there any like some call that as climax moves? I just wanted to
Uh,
confirm that.
uh,
But there's no prior trend here, no, to call it
yeah, so in
climax.
this one, I think this is a very special thing, which was a problem of supply because of the Russia-Ukraine war. But typically, if you see uh, certain moves like this, that is actually called a climax. You can see that in gold in August 2021, where the prices suddenly moved up very quickly and then started falling from there. So typically, if you look at any, uh, I'd say, any conclusion of a particular move, and especially an up move or even a down move, what you'll see is that during the last few days of that move, the prices will move up very quickly. And typically the prices move up very quickly when there are a lot of people who keep jumping into those stocks or those commodities also. And even in a bull market, what you'll see is that the last few days of a bull market or last few weeks of a bull market, we'll see some very sharp moves upward. And that is where a lot of the retail traders who would not jump
Stocks
into
are
the
down to
market,
them, sir. Yes.
yeah, who had not jumped into the market earlier, would jump in, and that is where the market would peak.
Right.
So it is actually a climax move, but yeah,
This was kind of like demand supply disruption and kind of move, right?
yeah.
Nickel.
Yeah, even if you look at oil in April 2020, where it went
Yeah,
to
yes,
minus
sir.
$35, it was the same thing on the other side, where people did not have storage capacity, and then they had to dump and even pay for other people to buy the oil from them.
Yeah, yes,
So
right.
these moves happen, but just make sure that you're not caught on the wrong side, because I think if I remember correctly, in March 2022, the uh, the margin money that was required for 1 unit of nickel moved from 1.5 lakhs to about 1.2 crores. Okay, just to hold 1 unit of nickel. So even if I had a long position and I made 56 lakhs, I still had to pay another 50 lakhs to the exchange or to the broker to hold my position because I felt that the nickel prices would go up. So, just make sure that whenever you're trading, and a lot of traders were caught on the wrong side because uh, there's nobody who was selling nickel at that time, and day on day, nickel prices opened up and they hit a circuit. So a lot of people who probably had a short position, wrongly positioned on day one, if they got caught on the wrong side, they probably were not able to exit till they lost several lakhs of rupees on just 1.5 lakhs in terms of margin. So coming back to Ralph Aganpura, price is a fact, okay, and somebody has traded those prices, and you can see what is the impact that nickel trade has had just because somebody is trying to reverse the prices, okay. But if you look at earnings are regularly restated, and nobody really cares. It's just business as usual. Principal metric of fundamental analysis valuation is based on price earning ratio. Okay, so they look at what's the price that a particular security is trading at, what is the earning that it will generate, and based on that, they figure out what is it that they're willing to pay for that particular stock. But having said that, if you actually look at what the fundamental analyst is doing, they also have a component of price in what they look at. And price is really something that is more based on technicals, and most of the technical analysts use price as the primary factor that would help them decide whether they would want to buy or sell a particular stock. Now, what happens in that entire thing is that when you actually look at what a fundamental analyst is doing, uh, part of it that they take into account is really a technical parameter. Okay, the PE ratio actually has some bit of price included in that, and that is why it's not completely devoid of what technical analysts would do. Okay, the technical analysts, while they focus on price, there are much fewer assumptions. Okay, so the P ratio is a formula that involves earning. And earning obviously has a lot of assumption, but as a technical analyst, we only look at the price. There's no assumption in the price. It is a fact. It is there on the screen. There is a trade that has taken place at that price, and that's why the price is moved up or down. There's somebody who's willing to pay the higher price. There's somebody who's willing to sell at that higher price. And that is how the price charts form. If you look at the fusion of technicals and fundamentals, okay, price is always a fact. It cannot be restated. Okay, and you've seen the result of what happened if once an exchange tried to restate the price, and there are a lot of cases that are going on, court cases that are going on after LME restated those prices and said that all the trades would be cancelled. So the people who made money, they've gone to the court to say that, hey, you can't do that. But I think there is a clause in all the contracts saying that if there is an event that would impact the stability of the exchange, then they can restate the contract, and that's what they're relying on. And that's the reason that they've given for why they cancel all those trades. But all said and done, from a technical point of view, or from the day-to-day point of view, prices are never restated. The same is going on for a lot of contracts where the prices of crude went negative, and somebody who is long, and especially if they had an option that was long, suppose they had an option for which they paid $10, a long call option, $10. The worst that you can do is get to zero. And in some cases, people had to pay $35 because of the fact that the prices ended up in the negative. Again, there are court cases that are going on that one also. I haven't tracked that too much to figure out what's happened on a lot of those. But from a general point of view, prices are not restated. And then it's really in something that a technical analyst relies on. Earnings are estimates restated time and time again, and so much so that uh, if you actually go back and look at the data on CPI, on inflation, even on the jobs that come out every Thursday, and probably I think the first Friday of the following month for the previous month, even the data that the government publishes, even they are restated. So the jobs report can be restated, the inflation numbers can be restated, uh, and to make an assumption based on something that is published is often very difficult, because you jump in and buy something because suddenly there's a good jobs report that has come in, but next week what you'll see is that there's another good jobs report, but the previous week's report has been restated to a lower number, and the trade that you took based on the previous week is no longer relevant because the previous week's data has been restated. Okay. The other thing that also happens is that when we look at some of the back tests that we do, so we say that okay, this is the result that a particular company announced, and that result suppose it was announced on 15th of April for the March quarter. Okay, you would look at the March quarter and say that hey, 1st of April onwards, this is the price movement, but you wouldn't have known the actual result of that company till the 15th of April, because 15th of April is when they announced the results. So you can't trade from the 1st of April saying that hey, this is how they performed on the March quarter, and 1st of April, this is where the prices moved. So just be aware of some of these things, that one, there's a delay in terms of the announcement of a lot of these fundamental data points. Okay, price is immediate. As soon as the transaction takes place, you can see that on the screen. A lot of the fundamental data is delayed, and then a lot of times they can be restated post that. So Ralph Akinpura, who's the one of the founders of CMT, he coined the term fusion analysis, which basically looks at both fundamentals as well as technicals uh, to come up with several things. One is what is the right way in terms of trading a stock. So you look at the economic analysis, which is understanding where is it that the economy is in terms of the business cycle. Now, business cycle was something that we studied, I think, in level 3. I don't see this in the current curriculum, but again, something that is important for us to understand. When is the economy in a full recession? When it is in recovery? When it is in early recession? Because there are different kind of companies or different sectors that do well during a recession. There are different sectors that would lead the recovery from a recession. Okay, so typically when you are in a recession, a lot of the defensives would do better than your uh, your high beta stocks, typically uh, financials and tech stocks. Okay, they would be probably the worst performers when there's a recession. Okay, so if you understand the business cycle, you'd at least be able to figure out what are the sectors that would do well. Then you first figure out the sector, then you do a fundamental analysis where you figure out, hey, okay, this is the sector that will do well. So suppose pharma will do well right now. Within pharma, which is the company that you want to pick up? Okay, then you look at quantitative analysis, which actually looks at the fundamental data and say that okay, this is what is doing well, this is how I'd want to select the stocks, or this is the P ratio that I would want to go in at. This is the stock that is giving me value. And then sometimes you'll also look at the chart patterns to say that, hey, this is the good entry point where, this stock has broken resistance, and then try and figure out whether it's the right time to enter or not. And then obviously, if you only use technical analysis, then you can use trend following, you can use mean reversion, whatever you're using. That is a comprehensive analysis of all the different factors that would typically impact stock prices. So you go from top down. You first understand where is the economy today? Okay, is it in a recovery? Is it in a recession? You then figure out what are the sectors that typically do well in a recession, what are the sectors that do well in a recovery, figure out quantitatively which is a good stock, okay, based on fundamentals, and then use that or use the technical parameters to figure out what is the right time to enter that particular stock. Okay, so as I said, you might have a fundamentally good stock, but that can still stay in a range, and you might have thought that this is a 10 PE stock and you'd want to enter at 10 PE, but it can stay at 10 PE for the longest time. Okay, when is it that you'd want to enter? Is really when the price is showing a breakout. This is a fundamentally good stock, good earnings, but the market is not willing to give it a higher PE than 10. Okay, so instead of deploying your money and waiting for a long time, you would probably want to deploy your money at a time where the market has recognized that stock and is giving it the right valuation, and there is some level of breakout that you can exploit. Each leg can have a scale of 0 to 100% with an initial value of 25% being used. So basically what Ralph is saying in fusion analysis is that you can give weightages to each of these factors. Okay, so you can give 5% over here, 25% over here. You start with 25% and then figure out, depending on what is the parameter that you want to use, what is the weight that you'd want to use for each of these parameters. And depending on the fact that, okay, if this one has suppose a 15% weight and not 25, so depending on where you are in the economic cycle, you would probably give a particular sector a particular weight. Okay, and if there's a stock that you've picked up from that sector, the economic environment will have 15% weightage on how that stock is doing, and based on that you'll formulate your own strategy. Okay, technicals can be applied at the last, it can be applied at the beginning. You can look at it in terms of what the economy is doing. You can look at it in terms of what the stock is doing. But one of the key things is that you should put a technical lens, because that is the only way you'll be able to figure out what is it that is making sense versus what is not. So if I look at both of them together, uh, there are several ways where we as technical analysts can also use fundamental data to take our calls. And similarly, even for a fundamental analyst, if they understand a little bit of technical, they would also be able to do better in terms of when to buy or sell. Okay, it's not only the stocks that you want to buy or sell. I think the important thing also is that when do you take that plunge into that market. Okay, so the key assumptions that we take into account is that market is a discounting mechanism. Okay, what it is doing is that you have certain cash flows over a period of time. You make sure that you do a discount on that to figure out what is the current enterprise value, and that is the stock, that is the price at which you would want to buy or sell that stock. There is a constant search for equilibrium. Okay, depending on buyers and sellers, there will be a price at which the market will be at an equilibrium where there are enough buyers and sellers and the prices don't move significantly from there. The flow of funds can provide insights into what buyers and sellers are doing and what is their behavior like. Okay, so all freely traded markets can be analyzed in this manner. Okay, so there are certain markets that are not freely traded, okay, including USD INR, because there's always an intervention by RBI to understand to prop up the rupee or let the rupee slide. But the key is that wherever there's a free market, okay, you would be able to understand that these few parameters would help you determine the direction of the market, and also understand that all these factors are interdependent. Okay, it's not that any one thing can determine what is happening to the market. uh, Fundamental analysts would look at discount, what is it that the future uh, enterprise value of that company is. People will be buyers and sellers in that market. All of them are interdependent in terms of making sure that the market is able to achieve a particular price level. So the fact that markets are interdependent, which means that there are different factors that come in and influence the market, typically is not something that a fundamental analyst considers. Okay, what does a fundamental analyst look at? They only look at what is the enterprise value based on what the future projections are. Okay, but a technical analyst also looks at what is it that the markets are dependent on. You need to look at what is the overall economy doing. Sometimes you look at what is the Federal Reserve, what is it that the Federal Reserve is doing, what's the amount of money supply. All that comes into play if you're using fusion analysis, where you're looking not only at the earnings of that company, but you're also looking at what the general environment is. Okay, if you go back to 2020 during the lockdown, okay, there's a time that all the prices moved down, but once the prices started rising, you'd have seen prices of all companies rising together. So whether it was airline, whether it was hotels, uh, whether it was leisure, even though there was a lockdown, people would not be traveling, but still those prices were going up. And a lot of that was just because of the amount of liquidity that the Federal Reserve pumped into the market. It wasn't because there's something that was fundamentally changing, at least in the first few months of the lockdown. But the prices still went up because there was a lot of liquidity in the market. And those are things that one needs to look at and understand that it's not just the fundamentals that are driving the prices upwards. It is also a function of money supply. It's also a function of the stage in the economic cycle. Okay, it is the interdependence of these various factors, okay, where there's enough depth and liquidity in the market that drives the prices. Okay, I'll stop over here. Let's see if there are questions, and then we will start with the slide on how technicians and fundamentalists can work together. Okay, any quick questions before we close for today? Yeah, go ahead. I can hear you. Yeah, cotton also had a 200% move. Yeah, if somebody is tracking cocoa, you can see that even coffee prices and a lot of the agri commodity prices, you'd see is there's a lot of dependence that it has on seasons, and there are a lot of seasonal factors that come into play. I think the other one that I wanted to show you was natural gas, and I'm looking at the global prices for natural gas. And you can see again, because a lot of natural gas production was disrupted because Russia was a big supplier to Europe. And you can see 2022 February March, this is where natural gas prices were, and it went up 142% during that same time, and all of it was because of the Russia Ukraine war. But over a period of time, what happened in the winter of 2022, Europe was able to uh, make sure that it gets enough supplies from the US, through different ways, typically through tankers. And you can see that as soon as the markets realize that there won't be a disruption of gas supplies in Europe throughout the winter of 2022 and 23, you can see that prices fell from $7 all the way to about $2. Okay, so a lot of those factors come into play when we're looking at prices, demand and supply being one. Also, the anticipation that the markets have on what will happen to the prices. So, yeah, I think yeah, cotton is a good example. I haven't tracked cotton because I don't trade in that, but yeah, I've been reading a lot of news that's there on cocoa and chocolate and coffee prices. So most of these commodities have gone up a lot over the last few months. I don't know what's happening right now, but this information is probably 2 to 3 months old, where both coffee as well as cocoa prices were going up a lot. Okay. With that, we come to the end of today's class. I'll stop over here and we'll start at 10 a.m. tomorrow. Thanks, everyone.
Thank you.
Thank you,
Thank
sir.
you, sir.
Thank you, sir.